Welcome to the Everything Apartments podcast. I'm your host, Eric Christopher. I'm president of WSC Realty Advisors here in Long Beach, California, where I've been an apartment owner, broker, and property manager for the last 15 years. This podcast is all about multifamily housing, spanning from buying and financing the investment to day-to-day operations and management, and even to reinvestment to help you increase your net worth. And as I mentioned, I'm here in Long Beach, just adjacent south from Los Angeles. Long Beach itself is about the seventh largest city in the state. And what's interesting about Long Beach, and it's about the most diverse city I've ever seen. And there's literally every type of apartment investment you can imagine right here in the city, from class A, toes in the sand, three cap rate stuff to tougher, more, urban class C assets. So in my mind, a discussion around Long Beach apartments can translate to the entire Southern California market. We have a wonderful guest here today. It seems that anyone who's been involved with owning apartments for a while would just kind of naturally think to become a developer, sort of like opening a restaurant. One of those things that people do when they achieve some success, they think about doing one or both of those things. And obviously, with anything speculative in nature, some succeed and others may not. And today we have with us Scott Choppin, who's an apartment developer with his firm Urban Pacific here in Long Beach. Also develops outside of the city, but we'll start the discussion there. Prior to opening the firm in 2000, Scott was a director of land acquisition for multifamily development at a firm down in Orange County called Saris Regis Group. He worked on developments in California, Arizona, Colorado. Before that, he was Kaufman and Broad Multi-Housing Group. So this fella definitely has been around the block on taking a piece of dirt and turn it into multifamily dwellings. With Scott, we'll briefly drill down on some of the intricacies of apartment development. Scott, welcome. How are you today?
I'm doing great, Eric. Appreciate it. Glad to be here.
Yeah, definitely. I was really intrigued to have you because as I've known you for a little while, I got into learning about the term that we've all heard, or maybe we haven't, called workforce housing. And when we started to align together and do some work together along the lines of property management and things, I've become more intrigued on the model, and I think a lot of our listeners would be as well. So, I mean, maybe start now. Can you share kind of how you arrived at this model and when it sort of sunk in as, yeah, I got to do this?
Yeah, no, I appreciate that question. So as Eric has referenced, we're a real estate development company, and we're really specialized in development of apartment projects. And that has been really the true for the majority of the 21 years that I've been founded and run this company. About four and a half years ago now, we started to look for a way to be contrarian to the marketplace in the development space in Southern California. And given my background at Kaufman and Broad, one of the companies that Eric mentioned in his intro, like I had a deep background in developing assets that served middle income families. And so we came up with the idea of what we call the urban townhouse, or UTH for short. And basically since that time period of beginning the idea of UTH for now 4 years plus, we've fully focused, and really that's the only product type we do. And UTH is a version or interpretation of workforce housing. Now, everybody has a different definition of workforce housing. So if you ask, 5 people, you get 5 different ways to look at it. For us, how we think of workforce housing is serving middle income families that are multi-generational and multi-earner in suburbanized urban areas. So these are older suburbs inside of a larger metro area like a Long Beach or Orange County or LA County that people are familiar with, SoCal. And we're really looking to develop assets that are like attractive to these family groups, attractive to roommates, to multi-earner roommates. We serve that population as well. But looking at that product type as a differentiated product, serving a gap in the marketplace. In other words, if you look at like the standard market would be market rate housing on one end, this is all multifamily new construction. On the other end of the spectrum, we have what I call true affordable housing. So that'd be government subsidized, low-income housing, tax credit, or other government subsidized housing. And we have UTH really placed to serve that family that sits in between those. So in other words, these are families that make too much money to qualify for true affordable housing. They may have 3 to 5 income earners in the family, but yet they're size of their family and the locations they want to live aren't served by standard market rate housing. So, they're not going to live in a studio in downtown LA or downtown Long Beach or by business center. So we're really serving this population that has really no outlet for living a lifestyle that's coherent with their family, lifestyle, which their share incomes and expenses across the family group, and also that they need the space to live. And so to meet that, we created this UTH product, which is a 5-bedroom, 4-bath townhouse product built to rent, designed and built to rent, but lives like a house. So 2-car garage, in-unit laundry, 5-bedroom, 4 bathrooms, fully central air and heat, brand new units, nice finishes, sort of, I'd say, middle of the fairway on finishes. But we do quartz countertops, production cabinets. We do a vinyl plank flooring. So from a, newness standpoint, like there's nothing like this housing type. And so we did some early projects to test the experiment because nobody's doing 5-bedroom, 4-bathroom townhouse rental product, certainly none at scale. And so we've basically developed a series of assets that ended up being what we call the demonstration phase. Prove that model out. We said, yeah, it works. We've done 3 projects, sold them, rented them, sold them, produced really good returns on them. And now we've shifted the entirety of our operations from a development standpoint wholly into focusing on this UTH model, and now are tracking an additional 8 projects, in all phases of development, from under construction through development entitlements, and then several projects even beyond that are identified and we're raising capital on now. So I'll stop there. Hopefully that gives a good background about like what UTH is and what workforce housing is.
No, absolutely. It's sort of a unicorn model because I was doing a little bit of research over the weekend on what is out there in the new construction format, let's say built from 2018 to present. And none of the properties that I saw, and there was a pretty good share of them in LA, ranging from 4 units up to huge complexes. None of them were formatted like this. Very few actually were formatted like townhomes. And I saw exactly 0 5-bedroom units. Once in a while, you'd see a couple 4 bedrooms peppered into a cluster of units that were more 2-bedroom, 3-bedroom, and then, oh, by the way, there's a 4-bedroom or 2. So the 5-bedroom model is a unicorn. The demand seems very underserved, and there's really nothing like it that a family with, let's say, 3 or 4 income earners and maybe a few small children around. There is no other answer like this out there. So it's a very exciting model. We feel it's underserved, and it's a very interesting thing to look at as it's happening in real time. So I really appreciate having the chance to kind of learn about this and see what's going on with that. Now, kind of maybe moving back into the larger discussion of development itself, like I mentioned early on. I've talked to countless apartment owners over the years, and it just seems like at some point in their travel, they're going to think about turning a piece of dirt into some units or another product type. Some obviously know what they're doing. They were already doing it, or somehow they have the resources to do it. Others are just pure gunslinger. Like they've got the money. They think that the apartment ownership they've had is sort of bequeathed to them the ability to develop, which I think we would both agree is probably a little bit of an overstep.
Mm-hmm.
So maybe take me through these 3 buckets you mentioned the other day. Very interesting, for sort of linear to understand of the development cycle.
Sure. So, as you mentioned, you meet people and talk to people who are thinking about this transition from investor to developer. And I've had this conversation really almost my entire career. In fact, my joke, as I mentioned to you, is that, various real estate people and even just people who are entrepreneurial, like my joke is that they all eventually want to become developers. And I think it comes from like a certain confidence, certain access to capital. And of course, real estate developers are entrepreneurs. So like, there's not a whole disconnect. It is generally coherent. And so as I started to think about it, I mean, I would always sort of get a kick out of the idea that, some guy that I knew would announce or that they were going to become a developer. And for many years, I said whatever, right? I was, maybe they had asked for help, maybe they wouldn't. So I was sort of agnostic to it. But in the
Hmm.
last like couple years, really 4 years, I really started to come to like terms or think about it like differently. So I always equated investment and development as, relatively the same thing. In fact, to me, to some degree, they were interchangeable. But I sat down and reflected one day and I said, I'm not an investor, not in the traditional way. I've really, my entire career, which spans probably 35 plus years, I've always been in the real estate development domain. I've never bought an apartment building like ever in my career. I've always bought land, designed buildings, built buildings, and rented units, right? Like that's what I've been doing. And so I finally came, I go, you know what? The investor and developer really are different. And, it seems silly to say that, go, of course. But this is the thought process, even people like you and me, Eric, like at some point it dawns on you, you go, oh, development really is different. So I came up with this idea of what I call the 3 bucket system. And this is the way that people can differentiate the skill sets that are applicable to investment and the skill sets that are applicable to development and where they overlap and where there's gaps. And that's the real key, is what are the gaps between what investors know and what developers know, right? And
Absolutely.
so,
That's the where the rubber meets the road in this discussion.
yeah, exactly. And so the first bucket is underwriting, right? That's what I call it. And so as an apartment investor and developer, we all have to assess the marketplace that we're looking to buy or develop in. We need to assess rents. We need to assess operating expenses. We need to find out population growth, job growth or decline. What are the demand characteristics and what are the rents that we need to set to make our deal successful, right? So that's bucket number one. And both developers and investors have to do that skillfully, right?
Right.
Bucket number,
Whether they do it to the extent a developer would, as an apartment investor, you may only spend a few hours on that to make your decision, right? What's the rents? Where are they
agreed.
going?
But developers like when we look at it, we because we've done so much development, particularly like in the UTH model would be a real good like use case here. Like we've done so much of that product so far and really done a lot of deep research that there's a whole bunch of background already there.
Hmm.
So I can go in and, you and I have had these conversations offline, like, oh, differentiating a little bit of micro neighborhood. Oh, this is like slightly up or down. But I can
Right.
generally say that I know UTH units right now in the marketplace in SoCal should go out the door about 3,500 per month for a 5 bedroom. And I'm probably always conservative, right? Meaning I'm always trying to early say rents are going down if that's the trend, or at least looking for that to happen. And although in this pandemic, in the 2020 recession, we haven't seen that. In fact, our rents have advanced, right?
Yeah. Right. Counterintuitive, I think, for all of us to think about
It
that way.
is, and the product UTH is completely contrarian, both in its like economic model, but also in like how it's perceived in the marketplace, both by tenants and investors. And in fact, the term we use is recession resilient. So in a down market where you would think real estate would become distressed, our product is one that actually gets better with harm. In fact, there's a
Yeah.
term anti.
Well, it's the same as 2 bedroom, 1 bedroom studio. Everybody in the world, and I think the normal is, hey, I'd like 2 bedroom heavy units on an apartment building I'm buying. But what do you want in a recession? You want studios at ones because the waterfall effect, where unfortunately people are, maybe losing some of their or all their income and whatnot, that those studios stay full in a recession,
Yeah,
where the
right.
2 bedrooms may not. And it seems like the exact same thing for you. And just a little color commentation on that. We've talked about this work at home thing's not going away after the pandemic's over.
Hmm.
I mean, if you're a CEO of a large company and you could shed half of your office space or some meaningful amount that's going to drop right to the bottom line,
Hmm.
you're certainly going to continue with the people working at home, which again, I think sort of lends itself to the 5 bedroom, 4 bath townhouses. One or two of those rooms is an office.
Agreed. The other comment I'd make about the 2 bedrooms is if you look at the housing stock generally in California, but specifically in Long Beach, as you and I both know, Long Beach has a high number of small properties, like in comparison to other cities, and the predominant unit type is a 2 bedroom unit. So the other
Hmm.
argument I would make in as a recession is I want the unit that's different from the mass or different from the herd, right? So I advised a guy at one point who called me and he was designing a new project, just asking my opinion. And I said, well, what'd you design? He goes, oh, 2 bedrooms. I go, dude, why'd you do that? He goes, oh, well, I researched the marketplace and that seems to be, there's the most of those. And I go, that's exactly why you don't want to do them. Because that'll be, you're introducing new units into a marketplace that has the most of that same unit that you're developing. So as a developer, and this will take us into bucket number 2, this is a good segue. Great. As a developer, we get to find a piece of land, design a brand new building that no one's ever built, and assess the market in the context of bucket number 1 and say, okay, we got a good beat on what the marketplace is. How do we differentiate? How do we produce what I call margin utility? In other words, what is the extra thing about our project or our unit or the investment that makes it just a little bit better than somebody else's project if we compare them to head, right? And so for us, basically, we have the capability to design to the market, where in a, as in any value add scenario, you're buying the market, right? Like, oh, that's a distressed asset. It's got 1 and 2 bedrooms. I mean, like, other than a small component of projects that maybe you could change the mix, like, take 2 bedroom, 1 bedrooms and turn it into 2 bedroom, but that's pretty rare. So you're really locked into what you bought. And in fact, the idea we have is where UTH is recession resilient, meaning it increases velocity, gets better in a downturn, that in our mind, value add is more distress prone, right? Because it competes in an inferior way. It's older product, and although you upgrade it and add value and rehab the units to compete, it's still probably got a unit mix that made it recession prone in the first place. So bucket number 2 is what I call the development bucket, and that's where we basically design brand new buildings. We underwrite, a heavier construction cost. So it's not paint and carpet and cabinets and countertops and appliances. It's a full build of demo, grading, framing, and every other trade that you have to do a new building. And so that's where bucket number 2 is. And I think that's really the differentiator. And the reason I do it in this order is because this is in the order of a project goes. You underwrite first, then you execute on your project. And then the third bucket, and again, where we get back into the overlap, is the valuation or the final, profit at sale, right? Like, we're all looking to, in our projects, to increase value from what we bought it for, and then sell it or refi it at a profit, right? And produce return and profitability to ourselves and our investors, right? And developers and investors are in the same boat. Like, we got to, buy low, sell high, right? In a value add, you buy a distressed asset or below market, you upgrade it, and then you increase rents, increase value, and then sell it, and you've made profit. Well, for development, as you and I talked about, I see that as the ultimate form of value add, right? We're taking an empty piece of ground, right? And we're designing a brand new building and looking for gaps in the marketplace, and we build it, and then we rent it, and then we sell it, right? If we do that at higher than our cost basis, right? Again, the same model of, buy or build low, sell or refi high, right? So it's the same fundamental economic model, right? It's just we're executing in a different space, right? Which is bucket number 2, and that space is new design, new construction. We have the political environment there, right? So if you have to entitle your property, let's say you have an industrial zone site, you need to rezone it to multifamily to be coherent with the design you want to execute on. Well, now you're talking to, planning commissions and city councils. And, this is the thing in California, we have the most heinous entitlement process in a political environment that's anti-development. We're getting a little bit better recently with, some of the new politicians at the state level, but there's a reason why California is the most expensive housing market in the United States. It's because we're so restrictive in our political entitlement and zoning process that we are basically every year artificially, capping the amount of units. And I don't mean that the state says, hey, you can only build X. It's just, it's so hard and so expensive and so risky that a lot of people don't do it, or only certain really well underwritten and robust projects profitability wise make it through the underwriting process to then be supportive of the risk that you would take, right? And so what it does, it just naturally squelches or reduces total development pipeline of anything, single family, apartments, condos. I mean, anything that's residential in California is suppressed, right? Like, it's just artificially the production is low.
Yeah, the outside costs are astronomical, right? So you've got like it was kind of a laugh when I think it was Prop 10 in 2018 came up to first propose rent control. Then obviously Gavin Newsom just put it through on his own. But did these people ever go to Econ 101? Did they ever study Keynesian economics? It's very simple. Supply and demand. It drives every market known
Yeah.
to mankind. And if you crimp one side of that, you're going to have a problem. So all of a sudden, they're artificially going to pin it on the greedy landlord,
Yeah.
plugging in rent control, which it's not going to solve anything. It's
Yeah.
all the supply side. Now, one thing that I wasn't interested in, it doesn't quite have to do with the UTH model, but the state got very liberal with these ADUs lately, last couple of years, where we're seeing a lot of that activity in Long Beach, where over the single story garage, they're allowing you to put a unit or two based on setback
Mhm.
limitations. And I thought, wow, that's uncanny for the government to do something that's proactive and efficient. But that, the supply side's where it's all at, and you hit the nail right on the head. If you're a developer, you've got a pool of funds where you're gonna go drive an ROI out of that pool of funds, and you could do it here or you could do it in Denver. And Denver's way more development. It's like a no-brainer. Why wouldn't you go to Denver rather than here?
Yeah.
So just based on the political environment and the cost factors involved. I mean, tell me a little bit about that. Like in the
Yeah.
UTH products that you've done thus far, I think I know all of them, but I may not. What have you seen as far as the differences in the city's receptiveness, or on the site selection, like maybe a little on the front end as you're going into bucket number two, because that seems like the big wild card in the equation, right?
That is, one of the wild cards. That's right. And so the initial answer is that when we did the demonstration phase, we only picked sites that had zoning already needed for the project to be developed, what we call by right. In other words, we didn't need to do any rezoning, no planning commission, no city council. We could just go straight to CD production, plan check, go. Right.
Mm.
Now, as we've expanded into our production phase and did more volume, meaning more projects total, and then bigger projects, we've had to sort of bleed over into the doing some what I call light entitlement work. So in other words, never a heavy lift, like major political controversy, neighbors coming out. Like, we have projects that just need design review. So the zoning is correct, but they want to look at how our buildings look and, tell us what to do, which is still a friction point. But, one, it's like, the risk is mitigated because, it's this color and that roofing material and that landscape. Okay, fine. But generally the unit count and the design is like, it needs to be accepted or it's allowed under the zoning, right?
Mm-hmm.
So for us, we as a California developer, I mean, we do, any California developer has to be good at doing entitlements because it just comes with the territory that you need to do that. That also, because we know it so well, is the reason why in the beginning we didn't do it. We didn't do entitlements. We said, let's skip that because we know what that's all about. And if we can like select sites that bypass that process, then we always will. Of course, there's a limited supply of those generally. So as we ramp up production, we have to, go into some light entitlement work. And that's fine. We're okay to do that.
That was going to be kind of a question I had was, as let's say, I think you have a few projects of 4 units online to start building. And then obviously maybe at the other end of the spectrum, and as the model goes, it would seem to me that as you wanted to ramp up production, you're going to insert yourself into heavier and heavier entitlement work, right? To find the viable spots to build. I mean, what's your thought on that when you say, okay, I'm going to expand this company? Where do I find the land? Is it here or is it out of state or?
Yeah. So, like it's perfectly logical the way you're thinking of it. And, you and I both talked to many, many people who are out of state and look at California like, we're insane. And to some degree, we are insane. I'll agree with that. Right. But if you get really good at it, then you know where to work inside the system. So you go by right first, and then like we're working on entitlements where we only do design reviews. So there's, they can't tell us no. That's what discretionary entitlements mean, is that politically the city council could just say, we just don't like your project. So we're just going to say no because, the neighbors are yelling at me, in the background, right? We look for entitlements that's what I call light entitlements. So in other words, there's no discretion to say no by the political body, but they can tell us what color and what landscaping. Okay, again, as I said, fine, like we'll go in and we'll deal with that. But we are taking on projects. And to your point, as you grow the pipeline, you can't but help to start to go into more heavy lift entitlements. But I always look at a story underlying. So is the political environment accepting of our product type? Does this, we go meet with city council people to gauge, hey, what do you think about this? Is this something? We talk to staff, we talk to city manager. And if I get any whiff of neighbors are going to come out and go crazy because you're going to be at planning commission, city council, I'm gonna dump that project like immediately. I just will go no. And we've looked at, so like there's several cities in Southern California that we won't work in because we know that the political environment is absolutely brutal against developers. There's some cities that are very developer friendly. Long Beach, where you and I are based, is sort of in the middle of the road. It's sort of developer friendly, but sort of a pain in the butt in other ways. And that's inherent in the business, right? And this is in this bucket number 2 is the capability to travel the political and bureaucratic complexities, right? And all developers and all owners sort of like deal with it, right? Like it'd be like if you own a value add deal and it had code enforcement issues that you had to deal with. So you sort of intersect with the government, but that's in a smaller way, or at least more limited. We are in a discretionary entitlement where they have full political, decision-making capacity. You're totally at their whim. And so you might even go, if you're in that process, you might go meet with neighbors. In fact, in California, it's a thing to go, like if you have a controversial project, you'll go meet with the neighborhood several times before you ever even get to planning commission.
Right.
No projects die. We have something called CEQA, and we won't go into the weeds on that, but we have the most constrained, environmentally friendly, like really intense building code, very costly fees and permits to actually build your building, developer fees, impact fees. So California is at the peak of difficulty. So then what you do is you go, figure out a way, you get really good at that, and you figure out how to work inside that. And then for us, and I'll finish here, this becomes a protective moat in it to some degree, Eric. In other words, if the world could come to California with our demand characteristics and the income levels that we have, everybody would be here. Right? Because you got tech, you got Silicon Valley, you got the entertainment industry, it's yada yada. But the political entitlement and development restriction environment scares almost everybody away, and rightly so. Or people go, hey, I'll come buy a deal, but Mr. Land Developer, you get it all entitled first. And then when you're done with all that risk, then I'll buy it from you. And we've done several of those projects and been, incredibly successful with that. But we shape our business plan for UTH inside of that. And then the final point is, look, our model is a workforce housing model. And what is starting to become more and more clear to cities, to answer your question about how do they react to it, and every city reacts differently, of course. But we come in and we go, look, we have a workforce housing model. You guys need this. In fact, the state of California has certain mandates for cities to develop a certain number of units every year, which of course they can never meet because we're so politically constrained. So we come in and we go, look, we're building housing for middle income families. We're building housing for teachers and firefighters, right? If we're so inclined to, we work with school districts sometimes and city agencies. Right. And they love that. And in fact, our model, because we use private capital and not government subsidy, we can come in and say, hey, we're going to build you middle income housing. We don't need any of your money. We just need your help in whatever way, entitlements or speed or expediting, or, sometimes we get land that the city might own. So it's becoming now more and more recognized that this is a product category, moderate or middle income housing, workforce housing is in need, and people are starting to go, oh yeah, we really do see this. People are moving away from California that are middle income families because they can't afford to stay here, or they're a big family and they can't find a 5-bedroom unit other than a house to rent that's coherent with their income category. So we're stepping right into that gap. And frankly, for us, it's a huge gap. Probably in SoCal, LA and Orange County, probably 35,000 units of demand, and just in our little narrow category of what the UTH product, the incomes and the family types that it meets.
Yeah, absolutely. And I can attest to that with the strong demand, right? Without reiterating too far, it's like there's nothing like it out there. If you want the 5-bedroom single family home, the cost factor is going to be substantially higher. You're not getting new product. And like you're saying, we all know people or friends of friends that are packing up and leaving California. Cost of living, quality of life, vis-a-vis that cost. And if you can put that product in front of, like I say, maybe a two family or an extended family, that's the magic bullet. And it doesn't surprise me a bit you say that it's 35,000 units underserved. That would be probably a number I would just pull out of the top of my head, but you can feel it. You can feel that demand for that product in the LA market.
Agreed.
And so it's
Yeah,
very interesting,
I
very
said that
intriguing.
same thing to Eric, to investors. Like I had a conversation with the Carlyle Group, like the big, head national level hedge fund and one of their groups here in LA County. And I'm like, dude, the demand for this is massive, right? And I just sort of did some math, and I think I was like, 40 or 50,000 units. But we did a study. We actually with a company called the Conquer Group, and in the 100 to 120% median income category. In other words, a family that is in that very narrow range of incomes, that's the 35,000. That doesn't include the 80 to 100 or even the 120 to 140, right? If you expanded those income categories, the number probably triples or quadruples. And that's not even going below 80%. Now realize this 80 to 120 has no subsidy programs from the government, either local, state, or federal government in any major way. I mean, there's little programs here and there, and it's starting to become more like, more available. But, affordable housing, is this big, and, middle income is this big, as far as the subsidy support or otherwise governmental support on a formalized basis, right? It's very ad hoc right now.
Tremendous stuff. No, I really appreciate you elaborating on some of this stuff, because I think as the viewers or the listeners think about doing development, my mind is stuck on that wild card number 2, the zoning and entitlements, and that whole bee's nest. So that's the art, right? And
it's a good way to describe it. Bee's nest, yes.
Yeah, no, I really appreciate you coming on and sharing with us, because I can say I can't speak for everyone in the real estate world, but I feel like it's a topic that anybody in real estate is interested in, whether they're doing it, had done it, thinking about doing it. It's just something everybody's into, just in the industry. So appreciate you coming on today, Scott.
Yeah, thanks, Eric. Great to be here.
All right. Well, I think that's all for today, folks. Stay tuned for the next podcast. We're going to be talking about everything about apartments. And today, obviously, we're in the development sector. Some of that would include maybe property management best practices. Hey, I thought about doing a 1031 exchange. I've just never done one before. How does that work? That's why it's called Everything Apartments. So thank you again. I'm your host, Eric Christopher, and we'll hope to see you on the next one. Thanks a lot.